Today, natural gas prices are rising primarily due to an expected seasonal increase in demand and heightened global export activity. As winter approaches, demand typically rises for heating in the US and Europe. Additionally, the U.S. Energy Information Administration predicts higher prices in November through March, driven by increased LNG exports from facilities in Texas and Louisiana. Moreover, U.S. nat gas production from shale and tight formations, which accounts for 79% of dry natural gas production, decreased slightly in the first 9 months of 2024 compared with the same period in 2023. If this trend holds for the remainder of 2024, it would mark the first annual decrease in U.S. shale gas production since we started collecting these data in 2000. In the European market, a combination of reduced storage injection rates and colder weather forecasts is also contributing to upward price pressure. These factors, along with reduced production from maintenance activities in some key U.S. production areas, are influencing both North American and global price trends. Current tensions between Iran and Israel have significant potential to impact natural gas prices globally, largely due to increased risk in the Middle Eastern energy supply chain. If the conflict escalates, it could affect key maritime transit points like the Strait of Hormuz and the Red Sea, which are crucial for global energy transport. An increase in hostilities could lead to disruptions in these regions, slowing down shipments or raising transport costs due to heightened insurance premiums and freight rates. Analysts estimate that if tensions persist, global gas prices could rise substantially as markets react to supply uncertainties. Additionally, Israel's gas production is essential to neighboring countries like Egypt and Jordan, with periodic shutdowns already reported amid the current conflict. Further escalation might trigger attacks on Israel's gas infrastructure, potentially halting exports, which would force countries like Egypt to secure alternative, often costlier, energy sources. Europe, heavily reliant on LNG amid reduced Russian supplies, may face price increases if Middle Eastern exports slow, especially as winter demand peaks. Today, nat gas prices broke past the crucial $2.40 resistance level, surprising many, including myself, who anticipated a longer consolidation around the $2.30 support. Bulls appear to have taken an early lead, which aligns with this seasonal uptick in natural gas demand. It's worth noting that natural gas is inherently cyclical, attracting traders who often enter and hold positions at specific times each year. The 50-day moving average, initially a resistance point, has quickly turned into a strong support level, establishing a firm base for growth toward the $2.50 resistance in the near term. This shift in support is reinforcing the bullish momentum and providing a foundation for potential further gains. With this momentum building, there's potential to push toward the $3 mark, though it may take time to fully realize that level. As I highlighted in last week's forecast, the $2.20 support zone provided an attractive entry point ahead of peak demand season, a prediction that held true as this level attracted a significant number of bullish traders. This period often sees an influx of bullish traders, which could drive additional upward momentum as we head into the heart of winter demand. Please like, subscribe, and comment to support the channel. See you in the next one.